The banks are hiking rates again. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee and we're going to look at a Yahoo Finance article which is discussing how, well, Commonwealth Bank has hiked some of its home loan interest rates. Now, if we think back to, well, just recent news and what's been going on, the cash rate is sitting at, and I'll bring that up at the moment. There it is, 0.1%. Now, that's the Reserve Bank's cash rate. But, of course, that's not the actual interest rate that we pay on our money. Unfortunately, I would love it to be. Wouldn't that be awesome? Imagine paying 0.1% interest. Hey, it might actually be close to the interest that we earn on our money sitting in the bank. But the Commonwealth Bank has hiked rates, everyone, on their 2- and 4-year loans. So let's have a look. Maybe is this the beginning, foreshadowing increasing rates? Because a lot of people now, the interest we're paying now on our home loans is a joke, everyone. It's nothing. It's so little, we're barely even noticing it. You've got people with these huge loans with repayments that cost nothing, really. Just think how much it costs to borrow $1 million. So, the Commonwealth Bank has hiked its 2- and 4-year fixed rates by 0.05% in a move that will leave many Australians kicking themselves. Really? The interest rate hikes apply to owner-occupiers paying principal and interest and marks a third time CommBank has increased its 4-year rate since the beginning of the year. It's the first time it has increased its owner-occupier 2-year rate. The new 2-year fixed rate is 1.99%, while the new 4-year rate is 2.29%. While a 0.05% hike isn't much in the scheme of things, anyone who was planning to lock in one of those rates but hadn't would be kicking themselves today, ratecity.com.au Research Director Sally Tyndall said. Well, Sally's right in that regards. Did you lock in your interest rate, everyone? We did. We got, 1.99% for 4 years. Our neighbour got it even lower. She got it down at, 1.79. So, good saving. It's all good. Take advantage of it while you can. But this is, of course, moving from principal from variable to fixed, and there's other conditions. Like I can only pay another 10 grand on top of my mortgage. But for these 4 years, I'm focusing on the renovation, so all the extra money I earn is going to go into the house anyway, so it doesn't matter. But if you wanted to smash it, then I can understand why you'd want to stay variable. CBA is factoring in a rise in the cost of funding over the next couple of years, particularly now the RBA's term funding facility has closed. So there you go. However, Tyndall said, it's unlikely the bank will move quickly to take its 2-year fixed rate above 2%. CBA's 2-year rate was extremely competitive and attracting significant interest, but keeping it just under 2%, the bank is trying to keep momentum going at a more sustainable price, she said. 65 lenders are offering at least one rate under 2%. Just think about that, everyone. This is the cash rate. 3% was considered the emergency rate at one stage. 3%. And that was for the cash rate. That was not for mortgages. Now we've got mortgages under 2%. What would happen to housing if it went negative? What would happen? I know it's hopefully unrealistic to occur in Australia, but what could you just imagine? Do you even want to imagine? Particularly here in southeast Queensland, Brisbane, this area around here, down the Gold Coast, the hinterland, it would go insane. People are already coming here now thinking it's more affordable than Sydney and Melbourne. What about Hobart? What about Lonnie? Adelaide? It would all go nuts as people leave the big cities. Sydney, Melbourne, sell out, go somewhere cheaper, buy a little place, sit on the rest. So, it's a great marketing tool to get new customers in, particularly refinancers looking to lock in a fixed rate that starts with a 1. The rate hike comes as homeowners refinanced some $16.24 billion in June, taking the 12-month total to $151.2 billion. That means 314,934 mortgages have been refinanced. Rate City Analysis found the average homeowner would have to save $10,430 in interest over 2 years by switching from an existing 3.08% rate to a new 1.95% rate. At the start of COVID, we saw a spike in refinancing as people rushed to lock in a competitive rate. COVID was a wake-up call for people to get their finances in order. Now, I'm hoping that will be the silver lining to this, that people will start to take control and have some agency over their finances. Although some of the other articles we're looking at where people are calling for UBI in Australia and bitching and moaning about having not bought like a new pair of glasses in 10 years, I think my hopes in a financially literate population here in Australia is pretty much out the window, everyone. I mean, come on. What's a new pair of glasses? $100. Doesn't have to be pretty. You can get the cheap ones. Just look at my older videos, guys. Look at those big plastic ones I had. I think I got 2 of them for $100. When you're married, you don't need to worry about it anymore looking flash. You know, you've already locked them in. There's sage advice right there. Over a year later, and we've now hit a new record high, although this time the surge is more likely to be fueled by fear of missing out. So there you go, everyone. We have interest rate hikes at the CBA. 2- and 4-year interest rates are both going up. Well, I mean, is anyone at all surprised? Let's have a look here. I'm just going to bring up one second. I'll bring up the share price for the CBA. Let's see how they're going. I just need to, because I'm so organized here. I'm just reprogramming it on the fly on my website, or vMix viewing here. We can see, well, $105.70. Nice. We'll go out to 5 years. You can see, well, we're well above where we were at the last, just before the crash, just before the big crash. So boom, so CBA just keeps climbing up, up, up. And there you go, everyone. One of the more popular of the big 4 banks here in Australia. You've got to remember, in Australia, the banks are a big part of our stock market. Top 10, most of them are the big banks. So what's the solution to all of this, everyone? Well, let me get on my soapbox. What? No. There we go. There's my solution. See, it's all well-oiled machine here. Well, this is what happens when I do tricky things. Well, here's the thing. If you're looking at your financial situation, you need to, if you're in trouble, you need to sit down and do a real budget. Really identify where every dollar is going. Now, this may seem like simplistic advice to some people, and I'm sure it is. I'm sure a lot of people follow it. But then you're not going to get any revolutionary advice from something you see on Yahoo Finance. But there are some people that this may be the first wake-up call that they've ever had. And I think a lot of people are shocked about their financial situation or how they were living week to week. Or maybe they've discovered the reality of living week to week once, boom, they've been locked down. They've had no reserves. And then they think, I'll just go on the Centrelink. But okay, no, the Centrelink's hardly anything. Oh, wait a minute. The Centrelink counts that share I had there or that emergency fund I had there. I have to burn through all of that before I can use the doll. It's not an insurance fund. I'm hoping that from all of this, people get a renewed sense of the importance of managing their own finance and their own agency and taking control of it. But that'd be what I'd suggest. First up would be find out where your money's going and then give it all a mission and attack your debts. I prefer the snowball tactic with debt. Not forgetting about interest, forgetting about what's more cost effective. It's the psychological benefit. So if you've got a small debt there of $200, boom, hit it first. Another credit card, $2,000, boom, hit it. Then you got another debt, boom, hit it. Then a bigger debt, boom, hit it. Hit all of them again and again, because then every time you knock one over, you get a psychological benefit, and then you'll have more liquidity, more spending money, and of course in Australia you just put that all into deposit and buy 5 houses. That's the way it goes. But with this, plan for interest rates to go up. And a part of that is getting out of debt and having free money that you can use. Also look at getting a diversity of revenue streams. And that's probably harder said than done if you're locked down. But plan for it. Use your lockdown to skill up so you have other opportunities. What would your suggestions be for this? Let me know your thoughts and opinions in the comments down below. Take care, guys. I'll see you next time.